Let's not talk some more detail about the Federal Reserve. It's powerful. It plays a role in your life, whether you know it or not, and it will have an impact on you. So, why is money important? A falling dollar value, a rising dollar value, it really, you can buy different aspects as to what the overall economy can do. Now, I want you to stop and think about this aspect on the global exchange of money. Canada is a neighbor. Now, that being said, if you have a Canadian dollar is worth $1.20 of American money, okay, that's different. But if the American money can actually buy $1.20 worth of Canadian goods, that's called a strong dollar. So the Canadian dollar can buy a dollar's worth of Canadian goods, but American dollar can buy $1.20. We call that a strong dollar. It's really nice to say, hey, we got a strong dollar. We're a tough country because we're strong. It sounds good because we can buy more Canadian goods than the Canadians can with their money. But the Canadians can't buy more American goods. They can buy less goods because their dollar is weak compared to ours. All of a sudden now, it's nice that we can buy all these Canadian goods, all these Chinese goods, all these Vietnamese goods, all these South American goods. We can buy from goods all over the whole world because we have a strong dollar, but we can't sell them products that are made in our factories. That's the value of having a weaker dollar. You got to pay attention to what it really means to have on an international basis for a strong or a weak dollar. Is a strong dollar good? Yeah, if you're a consumer. Is a weak dollar good? Yeah, if you're a manufacturer. Okay, so pay attention to exactly what it is. When the dollar rises or falls in the position of the US economy compared to others, that makes a huge impact on you, on your personal lifestyle. If you have a falling dollar, US tourism increases. You get more people loading up the hotels from other countries, resorts, theme parks. It's a big thing. There's more demand for US products around the world, so the products rise. So a weak dollar really helps our economy in a lot of different ways. It's a good exchange rate by U.S. companies, increases profits in foreign markets. So the falling dollar has a lot of value to it, but so does a strong dollar to the consumer for goods that we buy off the racks. So the Federal Reserve, there's 5 things you have to know about it, but I really want you to know about it, really just a couple. Number one, there's a board of governors. Okay, the board of governors, they have an open market committee that makes a lot of decisions, but there's 12 Federal Reserve banks, one governor from each one, and they have a couple different aspects of it, and there's member banks in the system. Here's your 12 Federal Reserve District banks. You'll see a lot of it, since it started really on the East Coast, you'll see a lot of it is concentrated there. Really, New York tends to be our financial capital of the United States because so much is exchanged there. But you'll see also when it comes down to the western side of the United States, one reserve bank covers a huge amount of territory geographically. So you'll see different aspects of it. You don't have to know what they are. I just want you to know that there's 12 of them, and that there is 3 different tools the Federal Reserve uses. By far, the most powerful and the least used is called the reserve requirement. It's a percentage of all the different money that a commercial bank has that they have to have in the reserve. Right now, it is 10%. So when you walk into a bank, you put $100 into your personal checking account that's held at that bank. They're required by federal law to hold $10 in a vault someplace. That's called a reserve requirement. So they put that money away, but the other $90 they can loan to other people that are coming in to borrow money. Okay, so therefore that money multiplier is a huge thing. So now you start out with $100. Okay, they put $10 away and they have $90. The next person comes in, they borrow the $90 and they spend all that money. So they take $9 out of circulation in the process because somebody else is putting that at their bank. So now all of a sudden that $90 goes down to $81. You can kind of see how you keep on taking your $100 and it keeps on multiplying as banks loan money across the board to different people. Now that money sits there. What would happen if all of a sudden overnight the Fed says, all right, we've had enough of this. 20% now. All of a sudden now you put your $100 in the bank instead of 90 to loan, the bank can only loan 80. And that person takes the 80 and they spend the 80, and all of a sudden now they can only spend $64 of the 80. You can see how the overall monetary aspect shrinks almost instantly by changing that reserve requirement. This is by far the most powerful one of all. So pay attention to that. This is an important one to know enough that it shows up on your test. The reserve requirement is powerful, and it requires banks to put part of the money that they receive in deposits away out of circulation and to loan. They have an opportunity to loan the rest of the amount to other potential loaners. They also have now a thing that we call the open market operations. Open market operations, we kind of hinted about it on government bonds and securities, is buying and selling US bonds by the Federal Reserve. The goal is regulating the monetary supply. So it really is the aspect of, okay, every Tuesday there's an auction of federal bonds and federal bills and federal notes at the Treasury. And people, they'll put X amount of $1 million out there and people buy it at certain interest rates. So if they're buying rates and it's 4.5% for a 30-year bond, which is pretty common. Okay, so you have that over here. What does it mean if the short-term interest rate on a note, which expires not 30 years, but expires a year from now, is 7.3%? Okay, so you have different regulations on it. So you'll see that plays a big part overall when they start selling a large number of bonds long-term. What they're doing is they're sucking money in from people across the United States and other countries. And in the process, they're shrinking the money supply by the more they sell, but they have to pay those things back. You also have from the member banks that are part of it, recall that's part of the overall formula, the discount rate is that they control the federal funds rate, which is how they sit down. And this is probably the most powerful tool, is called the discount rate. At the discount rate, a local bank can go in and they buy money or borrow money from a bank from the Fed. So the Fed says, okay, we're going to raise all the rates. It is now 5%. So a bank comes by, they want to buy some money. They buy the money and they're going to pay the Fed 5%. The bank turns around and they take that money. Guess what? They're not going to sell it to you for 5%. They're going to sell it to you for more money because they want to get the money to make money, just like any business. So the bank turns around and they sell it to their number one buyers of money for 7%. Okay, we just picked up our truckload of money over here. Well, I paid 5, so I'm going to sell it to you for 7%. Okay, so they take their people that are the very best ones, like General Motors, a big giant corporation, been around for 5, 6, 7, 10 decades. They give their favorite customers 7%. You and I show up. Well, how long you been in business? I've been in business 3 years. Okay, how many assets? Well, I got 2 stores. Okay, well, we like you. You're a nice person, but you're not like General Motors. So I'll tell you what, we'll give you the prime rate, which is 7%, and 3% on top of that. You mean you want me to pay 10%? Yeah, but I'm nicer than those people at General Motors. Yeah, that's right. Do you want me to pay more? You want to pay? That's how it works. So a lot of times you'll go in and you'll have a prime rate established by the Fed. The banks will follow suit because they're buying the money from the Fed, and they turn around and they give their best customers the prime rate, and everybody else will give a prime rate plus. It's pretty common for a small business to get prime plus 3. That's kind of a terminology that's out there. So you'll see that the discount rate set by the Fed plays a big deal when you want to borrow money. If you're going to borrow money from a bank, the bank's going to go through, see how much it costs them to get the money, and then sit down and reinvest it and provide loans out of it. You'll see the 30-year mortgage rate will vary a great deal depending upon the discount rate set by the Fed. If it's a high amount, if it's 5%, the bank can't possibly sell it to you for 5%. They're going to sell it above that because they have a cost of doing business. Now, it's a 30-year mortgage. You'll get a low rate, maybe even lower than prime to a business. But the reality of it is they're not going to go below the Fed discount rate that they're paying for. You're going to pay more than that. The Fed has a huge impact on everything that we do when they start playing games with all the different aspects of how they set that discount rate. 3 tools. Number one tool really is the reserve requirement. It's powerful, it's seldom used. Okay, and number two is open market operations where they're buying and selling bonds out in the market. So they're selling bonds every Tuesday. They'll sit down, they may call some back in the process as well. And then probably the one that affects us most on a daily basis, the discount rate, because they're selling money to member banks. The member banks are turning around and selling money to you, and the sale price is the percentage they're charging for you to repay that loan. The Federal Reserve also does a check clearing rule where they actually go through, and you'll see here's a graphic as to how they go by clearing checks. So you'll see how they pass the checks around. A lot of us still use checks. I don't know about you. We use digital checks for business on top of that. It's much faster and it's safer than a paper check. Paper checks are really a thing of the past in a lot of ways. The Federal Reserve System was established in 1907, and you'll see the Federal Reserve Act was all federally chartered banks had to join the Federal Reserve. So you'll see different things took place, and now we have this monumental thing called the Federal Reserve System. Banking in the Great Depression, you had the crash in 1929. It led to numerous bank failures, and Congress passed a series of things to strengthen the banking system. This is actually a picture where a bank locked the doors, and all those people standing outside, a lot of them didn't get their money that they trusted that bank for. So it was a devastation of our economy, and so they established lots of protections. And you'll have the three tools of the Fed: the reserve requirement, you have the open market operations, the discount rate. Know those three, not just for this class, but know for life, because it's a big thing. That discount rate will have an impact on you. 12 reserve banks. The Fed is the banker's bank. That's what we call it, because that's where bankers go to do their banking. And also know about the prime rate, what that means. That's the primary people that banks loan money to, and how that's going to have an impact on you, because almost for sure you aren't not going to qualify for that prime rate anytime soon. You'll have prime plus if you're buying for if you're borrowing money for a business or even getting a mortgage for your house. The Federal Reserve, powerful institution, know it. Take care.